our guest investor today, a man who has been through 20 plus years of an investing odyssey, to join us here today from the East Coast, currently residing in Milpitas, California, which is not the right way to pronounce it. He is a patent attorney, right? Patent attorney?
That's right.
Got it. Louis Hudnell, man, regular on the show. Welcome to the show.
Likewise. Thank you. Good to be here.
It's good to have you, man. We also got the JWB team in the house. JWB team. This is awesome. All right. Louis, are you ready to dive into the work that GC put into Case Your Investor Journey?
I've been ready for this. I'm looking forward to this.
You're here for it. All right, man.
Louis, I got to ask you, you're an incredibly successful patent attorney. What got you into real estate and what got you into being a patent attorney? Because they don't seem to jive for me.
Wow. Those are two loaded questions. So patent attorney was really just real simply, I was an engineer as an undergrad. When I was graduating from college, I didn't want to go out and work first. I still wanted to stay in school and get another degree. Knew I didn't want to be a doctor. I knew business school required you to leave and then come back to school, and I didn't want to do that. And so law school was kind of the only option to kind of stay in school. I didn't want to get a master's in engineering. I had enough engineering at the time. And so law school just seemed to be appealing. My dad went to law school, and so I just kind of did it. I did some due diligence, and I looked up the starting salaries for attorneys, and I was like, okay, this might be a good path, so let me do that.
We're all right with that.
And then when I got into it, the combination of an engineering degree and a law degree just kind of led to being a patent attorney, and my best opportunities came in the patent space. So that's kind of how that happened. But real estate, honestly, I really have to attribute it to a friend of mine from back home in Buffalo, because he was kind of a guy who just kind of always had like a hustle going on, right?
Yeah.
You know, he just always had a hustle. And he started telling me about how he was buying properties in Buffalo, which is where we grew up, for like 10 grand, 20 grand, 30 grand. I was like, get out of here. You're silly. Like I don't even want to hear, like, stop talking to me. And then he was doing like these cash out refis and telling me how much money he was making. I was like, you're ridiculous. But then I actually started like investigating. I was like, okay, he's kind of on to something. And I really have to sort of give credit to him, because he was kind of the one that planted the seed in my head to actually investigate it. And then by some stroke of luck, I ended up reading Rich Dad, Poor Dad around the same time. And when I read that, I think that sort of cemented it, just kind of that change in perspective that book gives you. So I think that's kind of where it started.
Man, I can relate so well to all of those things. Well, let's talk a little bit about numbers, because as I looked at your buying plan here, I loved everything about it. Knowing now that you're an engineer and you like planning things out and numbers and all that, can you talk to people about that buying plan, that process? Has it been very helpful for you?
Yeah, absolutely. And I think I sort of see my real estate experience in kind of two halves. There's kind of the pre-Fortune Builders half and kind of the post-Fortune Builders half. And it was kind of in the post-Fortune Builder, like I sort of realized when I got into the post-Fortune Builders half that everything I was doing pre-Fortune Builders, I was just kind of didn't know what I was doing. You know, I didn't have a plan. There was really no direction and that sort of thing. And, you know, it led to a lot of missteps here and there. But once I got into Fortune Builders and started thinking about this from a planning perspective, from a long range perspective, that's kind of where I started putting down these sort of milestones, so to speak, and kind of thinking about things long term. And, you know, one of the things that I see here, like the first thing I see on this line here is in terms of the why, like kind of the rationale behind the why. I mean, that is the why that's listed there, but kind of the rationale behind it, the way I think about it is, I think of my life as sort of like when I'm going to hit these sort of major financial milestones, right? Like when am I going to retire? When are my kids going to college? When are we going to buy primary residence? And I sort of line those up with the age that I'm going to be at those times. And then I need to figure out, okay, well, how am I going to do that? You know, like, my son's 11. He's going to college in 7 years. He's got, 7 years. I mean, that, to me, that seems like it's a long time, but it's also a very short time, right? And so you sort of have to like think about that hit that's going to hit if he wants to go to the schools that I went to. Like, you know, there needs to be money to pay for that, right? And so I just kind of work backwards from that perspective.
What a simple concept, but also a transformational concept, right? So Louis, this is where you stand after a year of ownership, only a year of ownership. And I think it's really important to understand the context of the last year. Pablo, what's the stock market done in the last 6 months?
Taking like a 20% haircut?
Lost 20%. For most retirement accounts, are they largely invested in stocks and bonds and mutual funds?
Largely, yes.
Yes. So if Lewis hadn't made that decision to move his money from the stock market, I'm assuming it was in, to rental properties, we're not just talking about the gains that we're talking about here. It's all of the money that he saved and preserved that he didn't lose in the other asset classes. So keep that in mind. Just a great decision for you. But Lewis, we're looking at 5 profit centers here. For your net rental income, you've actually been positive. I know the way that the decision is made here is it's about break even when you're buying non-recourse property. So some positive cash flow is certainly a win there, and that's certainly nice. Tax savings, you don't actually get any additional tax savings when you buy in a retirement account. Pablo, do you know why that is?
Because you've already deferred the taxes.
Exactly. You already get the tax savings. As Lewis was talking about his tax advantaged bucket, that's his retirement account bucket. So just because of the structure of his retirement account, he already gets tax deferral in place. So you don't get additional tax savings from a rental property. So it's a zero there, but just know that he already gets that. Principal pay down. It's really nice to know that our residents are paying our loans down for you. We always want somebody to just swoop in and pay off all of our loans. That's called rental property investing. So we have just under $2,000 of principal being paid down already just in 1 year for Lewis and for his family. And then this has just been a great year to be able to buy a property. 1 year ago till today, we've talked about it a lot, that, home price appreciation has been at an all-time high for a 1-year rate. The thing that I like to make sure everybody knows is we need to congratulate Lewis for making a great decision. And you've earned $30,000 in home price appreciation. But what many people fail to realize is they think that this only makes sense and that appreciation is only such a big component over the last year. When actually, if you look over a 10 or a 20-year cycle of holding onto this property, home price appreciation would still actually be the largest driver of his returns on investment. So don't fall in love with this incredibly high appreciation rate, Lewis. It's not going to be this, but we all need to look at all 5 profit centers when making a decision. And if you look at what historically accurate home price appreciation rates are, you're still going to see this as the biggest component of your return on investment.
And if we're talking about the Hervé own buying plan, right? Like this are $160,000 property that he's got $30,000 worth of appreciation. If that happens for a couple more years, he's able to take that equity out and pay for the next own.
Exactly. We talked about how nice it is to have a buyer credit to start out in advance and setting yourself up for success. Well, you and Lewis and everybody else who has bought, especially in prior years, right? You're starting out with this huge advantage. It's setting yourself up for success in terms of your return on investment, maybe even refinancing, maybe even pulling capital out and maybe using that towards other rental properties or private lending. And so when we talked about a year ago or 2 years ago, these are some of the things that are now possible because of those good decisions.
Awesome.
So here's how it stacks up. The expected return on investment for Lewis's property that he purchased 1 year ago was 1.8%, right? We didn't bank on any home price appreciation at that time, right? It was just gravy. Well, that gravy's really turned into over an 11% actual return on investment. This includes all of the costs that it would take to actually sell the investment as well. So 11% when you were expecting 2%. Lewis, how are you feeling over there?
Feeling great. I'm feeling great. This is the first time I've seen this. So no, that's great.
It's incredible.
Want to talk about this last little pie here?
I think we hit this already, but I always like to show the total percentage of returns by the profit center, right? Cash flow is important. It is important to look at, but is not the end all be all. Many people only look at cash flow. And what we try to share with folks on the show here is that it's important to look at it, but it's like your entry into the dance. It is the standard. You need to be positive cash flow. After that point, your other profit centers are actually going to make up the majority of your total return on investment. And that's what you see here, right? Even if we didn't have 20% home price appreciation, this graph would still largely be slanted towards home price appreciation being the biggest driver of returns. And that's not saying we're going to fall in love with home price appreciation, but it just says we're going to look at all 5 profit centers.
Love it. Love it. Lewis, what do you think, man? Overall?
I mean, overall, my eyes go right to that home price appreciation number because that's what I wanted. When I sat down with the Passive Income Club 4 years ago, I said, that's what I want. I want that high appreciation, no snow. And that's what I got. So I'm happy about that. Yeah.
Lewis, thank you so much for being here and for sharing your story. There's so much good stuff here to learn.
Yeah. It took me a while to sort of figure this out, but you have to figure out the way to play real estate, the way that sort of fits your life. And so now I just feel like this play, the way I'm playing it right now, fits sort of the station of life that I'm in. And I just kind of want to sort of maximize that now that I've kind of found like a nice little groove that I'm in. So just keep stacking those houses.
Love that, man. And if you want high appreciation, no snow, and have real estate fit into your life, you just can't be an average investor. See you next week.
See you, everybody.